With inflation and interest rates rising, are there any silver linings for investors? One DIY U.S. government bond investment you may not have heard about will soon be yielding over 9%. I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our bi-monthly look at what's been happening in markets and the global economy and what investors may want to know. As the war in Ukraine drags on with little signs of positive resolution and inflation becomes a more entrenched reality, the Fed is now talking about rate increases coming in higher and faster than the 25 basis point expectations of just a few months ago. The news has markets declining, stocks and bonds alike, you can see over the last couple of weeks. And with Friday's drop, most stock market indices are in correction territory, down over 10% year to date. This isn't unusual. Every year has periods of time where stocks draw down and bonds go into negative territory, but it's never welcomed by investors. And if you're feeling like things have been a little more volatile recently, well, you're right. The VIX, a measure of volatility in the U.S. stock market, rose last week. The recent increase has been above its 100-day moving average, so we've seen relatively more volatility recently. Tensions have been rising post-Ukraine invasion, and many investors are skittish now regarding inflation and interest rates. As usual, the markets tend to react strongly to the news of the day, even as many economic indicators show things are positive. On the labor front, for example, the U.S. continues to do very well. The economy is adding jobs, you can see on the top chart. Unemployment rate continues to fall, and wages have risen. They haven't kept up with overall inflation yet, but those rising wages are generally a positive sign. I mentioned that inflation is becoming a bit more entrenched or maybe higher than many expected. This has the Fed talking more aggressively about raising rates, and you can see this on the yield curves on this chart. The market is listening, and you can see how market rates have increased just over the past 30 days. The one-year Treasury has risen from just under 1.5% to over 2%. The 5- and 10-year Treasuries have risen over 50 basis points. The 3-month have risen over 75 basis points, and that, again, is in just 30-day period. So there's a lot of adjustment going on with interest rates in the market. So you might ask, why are my cash deposits at the bank or in my money market not tracking with these higher Treasury rates that we see in the market? Well, money market rates are notoriously slow to adjust up. They tend to follow the actual Fed funds rate, which, while anticipated to now rise by over 2% or more before the year end, has so far only risen actually 25 basis points. Now, if you need check writing and easy cash access, the U.S. Treasury may not be the best place for your dollars, but why would you want to move money from maybe your bank account or money markets into Treasuries? Well, check out that I bond yield on the lower right. That's right. 9.62%. That will be the yield of an I bond starting on May 1st. Now, that I bond is a niche little bond that maybe people haven't heard too much about, or maybe you've read a little bit about it in the news and wondered what it is that they were talking about. We'll talk about that in just a minute. Buying Treasury bonds is a little bit like shopping various banks for CD yields. In this case, though, instead of driving to a bank, you're actually going to be driving to your brokerage account, or more likely to a website called Treasury Direct, to buy these unique bonds. According to the Wall Street Journal, in terms of I bonds, over 11 billion of these things have been issued over the past months compared to 1.2 billion over the same period in 2020 and 2021. So they're increasing in popularity. I bonds were introduced by Vice President Al Gore and Treasury Secretary Robert Rubin in 1998 to help Americans save for things like college and retirement in an inflation-protected way. Now, one way to exceed the $10,000 annual limit that we'll talk about in a minute is that any individual can open the account. So in your household, if you have 2 individuals in your household, each person can open an account holding up to $10,000. But if we look through the attractions and limitations of the I bonds, you can see they have a very high rate of interest that adjusts to keep pace with the rate of inflation. We'll see how that's calculated in just a minute. The U.S. Treasury issues the bonds, so they're extremely high credit quality. There's no cost to purchase these things, and they're actually tax deferred in the sense that as the interest is added to the bond, you don't actually pay tax on the interest until you cash the bond in. However, there are limitations, and the one that I mentioned just a minute ago is individuals are limited to $10,000 of total purchases of an I bond per year. The bonds must be held for 12 months before you get credit for the interest, and if you sell the bond within 5 years, there's a 3-month interest penalty upon sale. Purchases must be made and managed on the Treasury Direct website by you, the investor. So this makes it a do-it-yourself option. And I can tell you that Treasury Direct website is a little antiquated, but if you have the patience, you can figure it out. The nice thing about these bonds is their yields do adjust with inflation, But if inflation begins to go down, that yield will adjust every 6 months in the wrong direction if you want to keep that 9% rate of interest. This is a screenshot of the Treasury Direct website. And if you go there, you're able to see that you can buy Series I savings bonds directly. These Series I bonds are the ones that are adjusted for inflation. And coming up, they're going to be yielding a little bit over 9.6% for the next 6-month period. Now, how is that 9.6% rate arrived at? Well, what the Fed does, or what the Treasury does, is they look at the rate of inflation over the past 6 months. So it's not the year-over-year inflation number that we see in the news, but a special inflation number that's just calculated for what inflation has been over the last 6 months as of the end of March and as of the end of September. And you can see as of the end of March, that inflation rate for the last 6 months had been 4.81%. If you annualize that number, in other words, take it times 2, you get 9.62. In the past, there had also been a fixed rate associated with these I bonds as well, but currently that fixed rate is 0. So the rate that's going to be assigned when we get to May 1st is going to be 9.62%. That will be the rate on an I bond purchase between May and November. So how often do the I bond rates change? I mentioned that they change every 6 months. What happens is the rate on your bond changes 6 months from the date of your purchase. So even though the Treasury adjusts the rates on I bonds in May and in November, if you buy your bonds, say in June, you're going to have 6 months of whatever the yield is in June, in this case, 9.62%. Point this out because there's really no rush for you to go out and do this. If you wait till after May 1st to buy your bond, anytime between May 1st and the end of October, bonds you purchase will carry the current rate, or what the rate is at that time, 9.62%. And 6 months later, they'll adjust to whatever the new rate is based on that 6-month rate of inflation. So setting the rate for May 2022, I mentioned that 9.62. Here's the calculation. 2 times the 4.81%, which is that 6-month CPI, plus 0. There's no fixed rate right now. That equals a 9.62. That rate is going to apply to all bonds purchased between May 1st of 2022 and November 1st of 2022. It's not too often you can look forward and say, hey, what's the rate I'm going to get and how long am I going to receive it in a guaranteed way? This is one of the few. It's issued by the U.S. Treasury. That's the rules. That's what you can count on. So if you're interested in increasing the rate on your savings, I would suggest an I bond. Unfortunately, you can only buy $10,000 per person. So for some people, that may not be worth the trip to Treasury Direct. For others of you who want to take advantage of that, we'd encourage you to do so. So as we think about the market, kind of where we've been so far this year in 2022 and what might be forthcoming before the end of the year, I'm reminded of this quote by Ben Graham in which he says, the market is not a weighing machine on which the value of each issue is recorded by an exact and impersonal mechanism, some kind of a machine in accordance with specific qualities. Rather, we should say that the market is a voting machine wherein countless individuals registered choices, which are the product partly of reason and partly of emotion. So if you can imagine millions of people transacting every day, deciding what to buy and sell securities for, stocks, bonds, other kinds of things, the idea that Ben Graham is talking about is that people have different opinions about what has taken place to date and what will take place over the next 9 months or longer. And all those people are voting as to what they think something is worth. And if we think about the way that we vote or come to our conclusions, we need to remember some of those conclusions that we make are reasonable. Some of them are based partly, at least, on emotion. And right now, there's a lot of things causing volatility and some skittishness in the market. So rather than getting too fearful, we continue to advise people to be diversified, to stay invested in a portfolio that relates directly to your plan and your personal circumstances. Thank you for joining us today. We're always glad to have you with us on our financial perspectives. As always, we would welcome your input. If there are questions like the I-bond question you'd like to see us address, please let us know at the contact information you see here on your screen. Also, if you'd like to meet with a Foster Group advisor, we would love to have that conversation with you, whether it's regarding your portfolio, your personal financial plan, or some kind of combination of things like that. Again, my name is Kramer. I'm the Chief Financial Officer at Foster Group, and we hope you'll join us again in a couple weeks.